Well, those are the headlines at this hour, and we'll be tracking all of the big news stories all evening on ET Now. Well, let's welcome on the show Dilshad Billimoria. She's the founder and chief financial planner of Dilzer Consultants Private Limited. Dilshad, thanks so much for joining us today on the show. Well, it's a very exciting time once again for the markets because, yes, the second wave did spook the equity markets a little bit, but we are back to our winning ways. The Nifty is at a record high, the Sensex is at a record high. But guess what? Reaching these record high levels even before the benchmarks with the mid and the small cap indices. So to start with, what do you make of this outperformance by mid and small caps, especially since it is coming after a long bout of underperformance? A lot of our viewers have always complained that, oh, you know, my small cap fund or my mid cap fund has not really done well. I'm sitting on losses. So what do you make of this outperformance which has come in finally?
Hi, Mubina. Thank you for having me on the show. So basically, the turnaround on mid and small caps has been, the same kind of story in terms of, very strong focus on quality by management. Companies which have zero debt, good, cash flows, increasing market share. And basically, these were the ones which were discounted to the current, Ps in the market. And that is why they have actually moved up the ladder of market capitalization, increasing their market share. And companies like technology companies have actually moved really well in times like this when we are in COVID because, technology is really caught on. So pharma, technology, mid-cap companies are, doing really well. Like, for example, Dixon Technology, is providing electronic manufacturing services to various multinational companies. So I think there is a very big catch-on the mid and small cap segment because these companies are well managed and have grown in market capitalization over time.
Okay. Also, we have the markets which are at record high levels. Now, a lot of individuals, we saw this last year as well, right? When the markets were rallying, the outflows from mutual funds were very high. People were redeeming more than they were investing in mutual funds, especially, in October, November, December, Jan. This was when the market was really rallying. What should be the investment playbook or investment strategy for a long-term retail investor when the market gives you these kind of returns, when it is at an all-time high?
So, Mubina, that's a very good question, and I think I've answered that earlier as well. I think it all boils down to the asset allocation, right? What would be the comfortable risk profile that an individual has? What is that asset allocation? And ensuring that at all points in time, a very close rebalancing strategy is kept, in mind to ensure that irrespective of the market swings or the kind of technical parameters, the strategic or long-term asset allocation is always maintained, at the individual level.
Okay, so we'll talk about that long-term asset allocation as well. Is this the time, Dilshad, to perhaps even consider rebalancing based on asset allocation in mid caps and small caps? Because there is a possibility, given the outperformance, that your exposure to mid and small caps may have been tweaked. So how should one really look at this rally as well? Is this a good time to consider rebalancing your portfolio a little bit as well?
Absolutely. This is a very good time to consider profit booking. I think the run-up has been quite stupendous this time, and it's moved in double digits as well. So it's very important to play a cautionary, role. Look at the next, the first quarter target numbers of companies have been actually quite good. The corporate results are showing pretty well, and I think that has also added to the run-up of the markets as such. Definitely a good time to do a profit booking on people's portfolios at this time.
Okay, I just want to ask the producer to pull up the 3-year, 5-year, 10-year chart of small cap returns, mid cap returns, and large cap returns, the fund returns. Throughout the time period, we have seen small caps do better than mid caps do better than large caps. Even though one may think that, oh, but if I had invested in 2017, it was a complete wreck, all the way only till 2020. So, and there was much more volatility as well. But again, if you look at the return, sometimes you think that I think it's worth taking the ride. In the last 1 year, a small cap fund has more than doubled for investors. How would you rate the risk and return of a small cap and mid cap fund versus a large cap fund?
Definitely. So when it comes to mid and small cap, the investor must have an appetite to see a downside of even minus 20-25%. So I think that is very important when an advice on small and mid cap stocks are given, considering that they could swing very high up and they could even move in the opposite direction equally fast. So I think looking at a time horizon of at least 5 years on the mid and small caps with, auto rebalancing along the way is an important criteria. And definitely this is recommended only for investors whose risk appetite is, aggressive to, very aggressive, because there would be chances of, a sudden fall and so quick enough that one could not possibly take any action.
So only those individuals who have a time horizon of at least 5 years should invest in mid and small caps, and of course be prepared for volatility. Now, considering the fact that only those investors who have 5-6 years should invest, Dilshad, right now, with these levels, would you recommend making new investments in small and mid cap funds, especially for those individuals who do not have any of these in their portfolio for whatever reason, or for those individuals who already do have them, is it a good time to perhaps enhance the SIPs in those?
Yeah, definitely. See, there are companies which are very strong, like I mentioned earlier, whose fundamentals are strong, whose balance sheets are lean, whose performance has been very good. I think those companies are, who are showing sustained earnings and sustained growth, sustained cash flows with, low debt to nil debt. These are the companies that are fundamentally strong. So I don't see them, what would stop them from becoming the next large caps of tomorrow? And catching them at this juncture would only help the investor, with the gains. But of course, a systematic approach or a systematic investment plan on these investments is recommended, definitely not at one shot.
All right. Now, you mentioned a minimum 5-year time horizon. Would you recommend allocation in small and mid caps for those individuals who are maybe at the verge of retirement or may have already retired as well? In fact, they may be 65, 66. Would you recommend a generous asset allocation for these individuals, or would you say that they'd rather stay away and invest in maybe index funds or large caps?
Yeah. I think for individuals who are looking at retirement within the next 2 years, definitely, not look at mid and small caps as part of their allocation. They should start moving their portfolio to, a more defined and well-balanced kind of structure. However, they could use the bucket strategy if individuals are okay with, a 7 to 10 year time horizon. Maybe a very small percentage of that retirement corpus, maybe 5 to 15%, could be allocated, to equity, but in the index and large cap categories.
What about those individuals who are younger? They may just be starting off their careers, and they want to now obviously invest in the markets. You mentioned asset allocation strategy. So keeping in mind that this individual is young, he or she is investing for wealth creation, for their future, what would be a good asset allocation strategy between all these different mutual fund categories?
I think definitely for someone who's just starting their career, having an asset allocation of maybe, again, this would be as a result of the risk profile. But if they're on the aggressive side, maybe a 60-40, 60 equity and 40. And in the equity, they could look more towards sectoral or even technology or, mid and small cap categories as well. And definitely have the core part of the portfolio also towards index-based strategies.
Okay. Now, Dilshad, this is the fact that the market is rallying is in a way good for all retail investors, obviously, but more so for those individuals whose goals may be approaching. In the last 1 year, when the market crashed, it was quite a hellish time for those individuals who are perhaps looking to retire because the asset classes that they had invested in may have lost a considerable amount of their value. So now, as for those individuals whose goals are approaching, be it retirement, or any upcoming payment, a house plan payment, etc., is now a good time to book those profits and move to less volatile asset classes, assuming these individuals still have money in small caps and mid caps? And if yes, where would you recommend they move from small and mid caps to?
Yeah, that's a good question, Mobina. So definitely, like I mentioned earlier, this is a good time for profit booking, rebalancing. And if someone's looking at retirement or has advanced retirement, so many people have even advanced their retirement because of COVID situation, etc. So I think we could definitely move the gains or move a considerable portion of the first 5 years of the strategy of regular income or drawings that one would need in the retirement distribution phase towards fixed income or guaranteed return kind of investments. Because today, if interest rates are between 6.5% to 7.5%, over the next 5 years, we are looking at interest rates falling. So it's important that they're able to lock in their savings at a higher interest rate today and draw upon that income over the next 5 to 7 years at a good rate. And again, the bucket strategy, like I mentioned, over longer term in equity.
Okay. All right. Well, let's quickly take on board some questions and queries as well. Remember, folks, you can connect with us. Our email address is themoneyshow@etnow.tv. So any questions you like to ask on your investment portfolio, how to invest, where to invest, you can email us. First question is coming in from Imran Bachwali. He says, what happens to my investments in mutual funds if I move to the US? I have been investing for the last 7 years. I've accumulated 10 lakh rupees in different mutual funds. And now he says, I've stopped SIPs last year. Can I continue holding them even after I move to the US? Dilshad, what are the rules like?
So obviously, when he moves to the US, either on work or on studies or whatever, he after staying in the US for more than 182 days, his status would change from a resident individual to a non-resident individual. At that point in time, he would need to inform the bank that he's banking with currently in India to change the status from RI to NRI, and subsequently inform all mutual funds or other investments that he's having to also update their records. And this is required by US regulatory requirements according to the FATCA guidelines, that all status of individuals migrating or overseas should be updated. So he would be given a time of 182 days to until he settles down and his status changes, and he can very much continue the investments that he's holding, except the fact that newer investments, especially for people who've moved to the US, there are certain restrictions on the kind and the nature of investments that are allowed as per the PFIC guidelines.
Well, I think it makes sense if you consult an advisor over there in the US as well, who will be able to give you a better idea of, the tax environment too, with respect to foreign investments, which, of course, in this case will be your Indian mutual funds. Thanks, Dilshad, for that. Well, very quickly, let's take on board one more question from Gopal Singh. He says, I'm 45, a moderately aggressive risk taker, currently investing in the below funds with a horizon of 14 years for retirement. He also says he will increase his SIP amount by 10% every year, so that's great too. 6 funds, Canada, Robeco, Emerging Blue Chip, Axis Focus 25, then some mid and small caps, Axis Small Cap, Invesco Mid Cap, the PGIM Flexi, and UTI Nifty 50 Index Fund. And he's got roughly about 1 to 2,000 rupees invested in each of these funds, a total of 12,000 rupees. What do you think of his a total of roughly about 9,000 rupees. So what do you think of his portfolio, Dilshad? Any changes you'd recommend?
So Considering his age, I don't know what would be on the debt side of the portfolio, but on the equity side, the funds that he's mentioned are actually among the top-rated, kind of categories in their various categories. But I think it should not be made very unwieldy, right? So try and ensure that you spread your investments with, even in equity, not more than about 4 to 5 categories maximum. So, but the funds that he's mentioned are good performing.
Okay, well, I think on that note, we're out of time. Dilshad, really appreciate you taking out time and joining us today on The Money Show. Thanks so much.
Thank you for your time.